The dollar has been strong for years, but what if 2026 is the year that changes everything? Today, we are going to look the Fed's two mandates, what the data is really telling us, and why the dollar could remain structurally weak into 2026. The Fed operates under a dual mandate: maximum employment and price stability. Everything they do, rate hikes, rate cuts, forward guidance, revolves around these two variables. To understand where we are going, we needed to understand where the dollar's strength came from. So, in 2022, the Fed delivered the fastest rate hiking cycle in modern history. Rates went from near zero to over 5% in record time. That created an enormous yield advantage versus Europe, Japan, and the rest of the world. And then in 2024 and 2025, markets started pricing in what they many called the Trump trade. Expectations of fiscal expansion, tax adjustments, deregulation, and tariff-driven inflation pressures. So the dollar wasn't strong randomly. It was supported by two powerful forces. First, the most aggressive monetary tightening cycle in decades, and the second, forward-looking fiscal and growth expectations. But here's the key question for 2026. What happens when both of those tailwinds start to fading? Labor data downtrend. NFP blue line. Job creation is clearly slowing compared to prior years. ADP, the orange line. Numbers are confirming this weakness. Private sector hiring momentum is fading. Unemployment rate is gradually drifting higher, not collapsing, but slowly deteriorating. The labor market isn't crashing, but it's losing momentum. Fed reacts to momentum shifts, not disasters. Now let's talk about inflation, the second mandate. Inflation peaked, rolled over, and has been trending lower. Yes, we saw a summer spike, but when we break it down, it looks like tariff-driven cost pressure rather than demand-driven inflation. Yields. Now, here is where it gets interesting. The dollar doesn't move randomly. It follows interest rate expectations, particularly the 2-year yields. The white chart. The 2-year yields reflect what markets think the Fed will do. When 2-year yields fall, rate cut expectations rise. The dollar weakens. If labor weakens and inflation cools, yields fall. If yields fall, the dollar follows. So here's the summary. What we have. We have labor losing momentum, inflation trending lower, tariff spike likely temporary, and 2-year yields sensitive to cuts. This creates a macro environment consistent with dollar weakens into 2026. This doesn't mean straight line selling. Markets move in cycles, but structurally, the pressure appears downtrend. The Fed's dual mandate is slowly shifting from restrictive to accommodative. And when policy shifts, the dollar eventually follows. Watch labor, watch inflation, watch the 2-year yields. That's where the real signal is.